Ashutosh Bhargava, fund manager and head of equity research with Nippon India Mutual Fund, joins us now. Ashutosh, good to have you on ET. Thank you for joining us. Ashutosh, bulls have been back for a while. Do you think for this market to sustain now, what needs to change? Because lot of concerns have got addressed. Fiasco in Adani group of stocks, high oil prices, high inflation, FI comeback. A lot of concerns which were there, let's say 3-4 months ago, they've got addressed. So what's next for the market now?
Good afternoon. So I think the next trigger would be the earning resilience. I think FY24 could be the year where earnings growth could be much better than the economic growth. So yes, there is a potential of some moderation in the economy, but earnings growth, thanks to domestic oriented sectors, thanks to broad-based nature of this margin tailwind across many sectors, I think could surprise. And I think even as you rightly highlighted now, FIs have also started to come back. Market may continue to climb the wall of worry, which has been the case locally as well as globally.
Okay. Okay, so that's the view, Ashutosh. Earnings resilience is something which is needed at this point of time. But what is showing resilience is the FI flows into India. What's your expectation there? Is that likely to continue? And more interestingly, where is that flow going? Because as we've been discussing, the large cap IT names are not seeing a lot of fund flow. Neither are the banking names. So where's that money going?
Yeah, so I think if you look at the FI ownership in India, it is at the lowest point of the decade at this point of time. There has been massive exit from the secondary market by the FI. Now, when the tide has turned, FI perhaps are realizing that there are very few markets which are performing as per the expectation or better than expectation. So India is a standout choice for a lot of these FIs, and I think money is now going into the broader market incrementally. Number 3, number 4 in every sector is demonstrating that the earning growth trajectory is similar to the leaders in the sector, and the valuation arbitrage is also available. So I think the broader market is, in a way, is a recipient of incremental FI flows, which typically, as you rightly said, goes into the frontline stock. But I think now there is a quest to look at the second line large cap or large mid cap kind of stocks where we are seeing perhaps more flows coming in.
Adani stocks, they are again shaky. You got Tata Com, that has hit out of the park. Trent, AGM, expensive, but it's doing very well. So Ashutosh, what's been your portfolio strategy? I mean, where do you think it's time now to take some chips off the table? Markets are paying price, are already baking in next 2-3 years of earning, because earnings will be there, but it's all about understanding what's in the price. Where do you think markets now are pricing in FY25 and 26?
Nikunj, the biggest problem for fund managers is reinvestment risk. So whatever has been working, if you have tried to book profits in those segments, say capital goods, high end of the discretionary segment, uh, and if you have got into something like say B2C segments, it has not paid off. And our strategy has been to be overweight on domestic demand oriented sectors. We have capped export oriented stocks and sectors as underweight in our portfolio. And we don't see a meaningful reason to shift out from domestic demand oriented sectors. Or if you categorize domestic demand into B2B versus B2C, I think still the weight of evidence is in favor of B2C segments like industrials, etc. So we are taking some profit off some of these, high-end discretionary segments like hotels, some of the capital goods. But frankly, we are doing these changes at the margin. We don't think still the time has come where we have to shift from, say, banking to IT or from this B2B segment to consumer stocks as such in a hurry.
whether you are coming back into consumer stock or not, but somebody is. Look at the surge in Devyani International at this point of time, suddenly spiked as much as 10%. And the other space which is doing quite well today is real estate. Macrotech developers was a bit of an underperformer this year so far, but today it's making up for that move. It's high by 8% suddenly, so a bit of a surge coming in as far as Lodha or Macrotech developers is concerned. But since we are talking about trend, let's go across to my colleague Vamakshi, because the company held their AGM recently, and the takeaways is something that the street is getting excited. Vamakshi, tell us what exactly was the read-through?
Well, yes, trend is in focus on the back of an AGM that the company held yesterday, and let me quickly take you through some of the important takeaways. As far as consolidated revenues are concerned, they hit the 10,000 crore mark in FY23. Apart from that, their strategy is to mainly focus on value offerings, even in a high raw material cost environment. And that, as a result, we did see that the company took a hit as far as gross margins are concerned. But on the EBITDA level, the EBITDA margins have actually improved on the back of operating leverage. Zudio has demonstrated a very strong ability to gain market share in the value fashion segment especially, and in fact it has been able to do this while improving its profitability as well. So Zudio now contributes around 40% to the standalone revenues versus almost 16% in FY20. As far as the store addition is concerned, they have been aggressive in the past and will continue to do so. In FY24, they plan to add 30 stores for Westside, 200 stores for Zudio and 10 stores for Samo. In fact, this would outline a capex of almost 800 crores, which is expected to be largely funded internally. Now there are some new growth engines that are also emerging for the company, out of which Star is expected to be a key growth engine, and that would be driven mainly by its cluster strategy, value offerings, as well as scaling up their omni-channel presence in order to make it more profitable. New segments such as Utsa and Misbu are also ready for expansion, and in fact they are also planning to scale up their recent foray in the ethnic segment through Samo by increasing its store count to 100 over the next few years. So largely those were some of the important takeaways from trend, and on the back of this we did see the stock hit an all-time high intraday today.
Okay. Ashutosh, where do you think some of these expensive urban consumption stocks are headed? You know, Trent is expensive, but it is going up. Sula is expensive, it is going up. Ethios is expensive, it is going up. But they are going up because there is growth. So how does one know that we should ignore the short term, we should ignore the near term price and then bet on the next 3-year trend?
Because the thing in the market, and we all are aware that this K-shaped recovery that everyone is talking about is visible quarter after quarter, including the last quarter. I think there is no sign of this mean reverting in a hurry. So all the high-end segments, consumption segments, earnings are surprising on the upside. We are still seeing the upgrades. Wherein in contrast, it looks like we are looking at to India. Anything which is low end and I would say lower middle class, low ticket consumption item, we are seeing a meaningful moderation in growth. I don't have a strong reason to believe that this is going to change in a hurry. And perhaps it will continue. And that's why for fund managers, it is very difficult to shift from something which is working in your favor, like hotels, like these high-end retail companies, airline company, etc., to lower in consumption, which has been a big underperform the last 1 to 2 years.
You're finding it difficult to move, and that's something actually that our other guest also pointed out, that he's being very lazy in the market and not changing his position, and that was Pankaj Murarka as well. You know what, Ashutosh, we let you go on that note. Thank you so much for joining us today and talking to us about a whole host of sectors. But